Ladies and gentlemen, please welcome your panel on the emergence of venture capital megafunds, moderated by co-founder of March Capital Partners, Sumant Mandal.
So we're almost done. Thank you for being here. It's really nice. I was here last year as well. Last year I was not moderating, so it was a much easier task. But this year we have a very interesting panel for you. We have everything from a very early stage seed investor who's been super successful to someone who's been doing mid-stage ventures, traditional in China, to someone who is, 10 years ago, would not have been something in anyone's imagination, a $100 billion fund, and then a sovereign wealth fund from Abu Dhabi. And so I think it'll be an interesting sort of conversation. Hopefully we'll walk away with some insights into what's going on in the world of venture capital. And rather than spending too much time on it, maybe what I'll do is maybe start with you, Akshay, and maybe give people a little bit of insight into what you are seeing. I think everyone knows what the Vision Fund is, but your thoughts on the world of venture capital and what's changing.
So I think it's important to put in perspective why Masa wanted to raise a fund that was this big. And he's always been a believer in the information revolution. And I think if you go back to the early 90s, that's when the paradigm shift started taking place, where businesses across the spectrum, sectors, started getting disrupted due to the internet. And that kind of was the onset of the information revolution. And with the paradigm shift that's started to take place back then, you've now had a ubiquity of information across the world. You've had increased processing power. And we believe that we are in this stage or this cycle of disruption where we're going to have an exponential shift due to all of these reasons, and artificial intelligence, which due to increased computing capacity and power is just going to go out and disrupt every single sector. And so his vision around finding disruptive businesses in one geography, which he can then take global, requires a lot of capital. He has the experience of being able to internationalize businesses, obviously Alibaba being the most marquee investment and example of that. And I think the ambition that he has and the scale at which he wants to go out and disrupt these different sectors, I don't think you could have done it with even a $10 billion fund. So,
but having said that, he's been doing it for the last couple of decades. So the Vision Fund is really an extension of what he was already doing.
So I think Ibrahim is here, and he'll
Don't worry, he's next. He's next.
He'll attest to it, but he said that I spend 97% of my time thinking about operations and buying my telecom businesses and all of that stuff. I spend 3% of my time making investments, which is true. And now what he calls Softbank 2.0 is where he's spending 97% of his time making investments. And given the audacity of his vision and his thinking, with 3% of the time he was able to achieve all that. When he's spending 97% of his time, he won't be able to
Basically, you're saying we should short the Sprint stock.
Why Sprint? You really want to short the Sprint stock, or you're talking of SoftBank?
SoftBank.
Sprint
SoftBank.
is hopefully soon going to become T-Mobile's problem.
That's true.
Yes.
So Ibrahim, what part of this story was appealing to you? And given that I think from your side is the largest commitment that I know of that you've made,
Exactly.
at least in this space. How do you think of that? And then maybe for the audience, a little bit more about how you as a group and Mubadala Ventures is thinking about technology investing,
Yeah.
and you've opened an office yourselves in the Bay Area, and what that means, and Give us a little bit of insight into how your group is thinking about this space.
Yeah, so Mubadala as a whole, and many of you heard our CEO yesterday, Mubadala as a whole is sort of taking a very active and forward-leaning approach to technology in general. And the real premise there is sovereign wealth funds, we're investors in energy and infrastructure, in water, in power, in real estate. But we didn't invest in significant platforms like Facebook and Twitter. Twitter, you think about Twitter, you know, Twitter is like a public utility today, right? I mean, you can't have a conversation without the role of Twitter.
You can run a country on Twitter. It doesn't matter.
You can run a country. So we took a view that Mubadala has to become a lot more of an active investor in this space. Okay. And there are multiple approaches to do it. We are very partnership-oriented, so we spent time with Masayoshi's son and concluded that SoftBank and Masa are probably some of the best partners we can have in investing in transformational companies. And at the same time, we also really wanted to invest earlier on in that cycle. And the way to do that is we'd have to take an active approach with early stage ventures. And if you want to do that, you have to be in the community with the founders, with the network. And you can't do that just in Abu Dhabi. You'd have to do that in San Francisco. You would have to do that in China. You'd have to do that in London. So our technology and in ventures approach is sort of quite a cohesive strategy that says, how do we find the right partners? Well, you know, Fred will speak to you about his fund, Stride. We're LPs in that. Earlier on, a guy like Fred who spends time in the trenches with founders in Europe. And then how do we partner with a guy like Masa, who is an incredible visionary, a powerful technologist, and who really believed that he needs significant capital to invest and build big, enduring companies. And ultimately, that's Mubadala's strategy as we continue to become global active investors in the space.
And you know, Silicon Valley, by the very nature of having been sort of where a lot of this has happened, is also sort of a closed system where you have cliques and you have people who work with each other. And so how's that been for you coming in from the outside with a very large pool of capital behind you, may or may not be only for technology? And yeah. what have been the challenges?
So 3 years ago, we set out to meet the top 40 funds in Silicon Valley. And I would say 50% of them said, you know what, give us your money, stay in Abu Dhabi, we'll do a better job than you would.
Just 50%?
What's that?
Only 50%?
50%. The other 50% were a bit more diplomatic in how they fast forward 3 years, and the message to Silicon Valley is, we're a part of the community, we have an office in San Francisco, we're active here. We are not Benchmark, we are not Andreessen, we are not Sequoia, we are not trying to be what you are. But you cannot be what Mubadala is. You do not have the global scale and network and access and assets that we do. So how do we work together to invest, define, select, and make decisions with the best technology founders out there? And, you know, are we there? No, not yet, but we've made a lot of progress. We've partnered with exceptional funds. We are working closely with the Vision Fund partners. You know, we win some, we lose some. In Silicon Valley, if you don't lose great opportunities, that means you're not seeing the real great founders. So, you know, it's like everything else in Silicon Valley. It's intense, and every day is a new day. So, you know, I had this discussion with a Sequoia partner. We are LPs in Sequoia. And he said, fundamentally, the problem with you sovereign wealth funds, there's two major problems with sovereign wealth funds. Number one is you're not consistent. You show up, ventures is hot right now. Everybody wants to talk about ventures. You show up for a couple of years, the cycle comes, and then you disappear. And number two, you don't carry the weight of the startup journey on your shoulders the way we at Sequoia do. And my response to him was, Mubadala is here for the long term. We're not leaving. Mubadala will continue to build its technology franchise way after we're gone.
And you've started to do that in Europe as well. And so maybe, Fred, from your point of view, first you're sitting between, I don't know, $1 trillion and $100 billion, but you're the one helping founders get up and running. What do you think of this ecosystem and the developments over the last 4, 5 years, 10 years?
Yeah, so I mean, I'm an artisan, right? I would say two things. So one is, what's fascinating is that we started with digital, so music, then movies, then we went to listings, and now we're touching every segment of the industry. So the secular view of venture capital, and why I think it's becoming a bigger part of GDP, is that we're attacking food. I funded Deliveroo, which you see everywhere here in Dubai and Abu Dhabi. But then now we're attacking agriculture, and we're attacking industrial automation. And so you see, and the incumbents can't really react, and sometimes they don't even understand how they're being disrupted. So the scope of opportunity keeps expanding. And to a certain extent, we're even bumping into biotech now with computational genomics. So it's fascinating to see. It's a wonderful time to do what I do because we've seen this opportunity expand laterally. From a VC structure market standpoint, so we basically have three models. We have the artisans, like, we're trying to be a bit like a mini benchmark. USV, people like that. You then have the platforms, with services like Andres and Horowitz, and then you have the network-based models like YC, which is almost like a ghost in the machine, right? It's the network that feeds the investments and actually makes the decisions through a form of social proof. Now, with the advent of the mega funds, the game is changing quite dramatically because suddenly, the markets have become perfectly transparent. So it's not like you unearth companies that nobody's seen. With the ability to use data and to use data platforms, the big global funds are seeing which companies are rising up. They're metricizing it very precisely, and so starting with DST and today Softbank Vision, we've started to see pools of capital that move on a global basis and identify the winners, which is a real challenge to sort of the mid-market, because
so if you're not one of the winners, do you have a shot at making something work?
Well, so I think that...
Or are these global funds anointing winners?
Well, so the global funds to a certain extent are anointing winners. The best ones are. What is a little bit scary is that every asset at scale is being priced as if they'd already won. And I mean, I know from experience that being at 20 million, 50 million, 100 million in revenues doesn't mean you've won, right? So I think that it's a bit like the Sequoias of this world. The best tend to pick the best assets. But then there is a real concern on my part that everything's being priced up as if the risk had been taken out.
For you, as a seed stage investor, having someone price it up is a great thing. It's not a bad thing.
Well, so there are challenges to hyperscaling as well. So there are two challenges, I would say. One is, it is really hard to grow fast without vaporizing cash. It is really difficult to scale companies at infinite speed without being inefficient with capital. And then number two, actually for us, it kind of pulls our reserves forward. So people don't think about that, but we're small funds, and so we're being forced to make reinvestment decisions at high speed.
When you're behind such a big fund on the cap table, it's very hard to keep up.
So that poses some challenges. And I would say if you look at cycles, so let's say we're going to head in a down cycle in a year or two. My only defense, being a midget compared to some of my respected neighbors here, my only defense is temporal diversification. I want to invest a little bit more slowly so that I have more time and more intelligence around where I put the reserves.
So there's no perfect answer, but when we're talking about scale, I don't think we can actually ignore Ron and China. And I think it'd be interesting from your point of view, as you're hearing this conversation, given that China is now 40% of all venture dollars and up maybe 4x year over year in percentage-wise. And how are you thinking of this world, and what makes sense here, and what's different in China?
China is venture market in China is very early. It's really only been around for 10, 12 years, and it's gone from even 5 years ago, 20% of U.S.'s size to now about 70, 75% of U.S. size. It's very reasonable to project that it will be the biggest venture market in the world within 5 years.
Why do you say that?
Because the numbers are in front of us. You look at China, the middle class in China, defined as income over $15,000, and it's only 100 million people. Yeah. It's not even 100 million. I think it's 80. That number can go to 500 easily. I mean, you can have within China multiple Americas in one.
The rhetoric you hear, and I would love your thoughts on, is that there's a slowdown in China. And there are these 3 or 4 massive companies that dominate the tech market. And not just in China, but they're dominating the region as well, or trying to in the world. How does that work for you as an early stage VC? Where do you see opportunities? How do you play in that ecosystem?
Yeah, so first on a macro, don't forget 2 years ago, everybody's talking about China being overheated, too much debt, there might be a problem. And then last couple of years, especially last year, the government start pulling back some of the debt, a lot of deleveraging, especially from the state-owned companies, industrial companies. And the result is a slowdown. I mean, that's what happens when you do that. So, but more importantly, that money is going to technology, going to consumer, going to services, and that's the future. So there's rebalancing the economy going on. So I wouldn't worry about the short term. If you look at some of the fundamentals, I would say 2 data points are very exciting. One is productivity growth. Productivity is at an all-time high. That's always a leading indicator of future growth. 2, the number is not out yet. I think it will come out very soon. China is going to end up in 2018 as the first year, maybe not ever, but in recent memory, to be a net importer of the world. I think there's a sort of a narrative out there that China makes cheap stuff, sells cheap stuff to the world. That's how they make their money. It's not the case anymore. It's a net consumer of the world. I mean, once we reach that point, you don't go back.
So if you focus a little bit on our world, which is more seeding companies, starting companies, helping them succeed, taking them public, when you have, even in the US, you have dominant players like Google and Facebook, to try and build companies that quote unquote come close to them is like, putting your hand close to fire. It hasn't worked. Personally, it hasn't worked for me. So you try and find areas that you can create innovation in. What's the Chinese ecosystem like? Where do you see opportunities? Where do you see, is it competitive? What's the dynamic?
Well, it's interesting you say that because certainly there are large, giant companies in China. We all know them.
They are the Chinese mega funds.
They also compete at the later stage for deals. They are hundreds of billions of market cap.
Very low cost of capital.
Yeah, and they continue to grow. So it's interesting. We're an early stage fund. We focus on Series A's. One of the shortcuts we learned of deals that we should do is when a CEO comes into our office and say, hey, I'm building a product, I'm doing this thing that's going to be better than Alibaba. So we love going head to head, not in terms of their core business, but in terms of areas where they're not as good at, or different twists to the model, or new addition to the technology. Because these big companies dominate mega spaces. As a small fund, different than a few other guys here, we manage about $300 million. If I can produce $1 billion return on a deal, that's really, really meaningful.
That's 1 day of interest.
That's really, really meaningful to us and to our investors. So I'll give you a quick example. 3 years ago, we invested in a company called Pinduoduo. We led the Series B. I'm not sure. I think most of you haven't heard Pinduoduo. Pinduoduo is now second, third largest e-commerce company within 4 years. They went directly against Alibaba and created a new category called social e-commerce, where people buy in groups, people share products with each other, and really formed a new concept in commerce. It's formed in China. It's less about you finding the product on a platform. It's more about the product finding you through the friends, right? So it got very viral. It became a viral e-commerce platform. And get this, they grew from nothing, 2015, just started, to now over $100 billion revenue, run rate, $100 billion. And Alibaba's not hurt by it. They're not hurt by it. They're still growing. Market's big enough, GMV, and make some a top 3 player in the market, and you know, that returned 2x of the fund for us.
So Chinese scale is unimaginable, and so you have that opportunity. Ibrahim, do you guys think of investing geographically as well, and do you have different strategies for different geographies?
You know where we're trying to get to, Sumant? We're trying to get to a place where Ron and Fred, when they meet these exceptional founders early on, Ron, $300 million fund, $200 million fund, $100 million fund. We're trying to get to a place, whether that's US or Europe and in Asia, where when they identify an exceptional founder and seed that exceptional founder, they, in their mind, start thinking how they can introduce that founder to Mubadala very soon. And they should be proud to do that. That's not the case of how sovereign wealth funds of the past interacted in the technology world. How is it that Mubadala can support this founder? How is it that Mubadala can follow on and work with us as a long-term investor, as a thoughtful, active, smart, insightful investor? We can't do that without Ron and Fred active in the community. With the Vision Fund, they just need to make us money. And just given how much we've invested in that fund.
Are they making you money?
Yes, they're making us money, and they just need to keep making us money. Okay, don't worry about us, Vision Fund. Just make us money. But for people like Ron and Fred, we just need to really engage with them. Like I was with Fred in London 2 weeks ago, and we were talking about insurance marketplaces and fintech platforms, and we were whiteboarding some ideas, and I'm asking about some of the founders. So look, I wouldn't be able to do that in Europe without a partner like Fred. And that's our strategy. It's not a geographic-based strategy, but it's a very partnership-based strategy.
Understood. I think there are other sovereign wealth funds that have done that quite well over the years, especially Singapore and a few others that we are close to. So, talking about making money, how does a $100 billion fund make money?
I mean, first of all, if you take Uber as an example, right? A year and a half ago, the company was in a real mess. I mean, they had bad culture. There were some really bad decisions that were taken by senior management in the company. And a lot of these early stage venture funds came to us and said, hey, give us liquidity. And, we do stand for principles beyond making money as well. And we said, we'd be very happy to give you liquidity, but we need to clean up the whole shop here. And it started with not only cleaning up the cap table, but it also started with us having a say on who the CEO should be, how the board should be structured, and making sure that we have a company that's got values around diversity and so on. And that's a situation, a prime example of what a large fund can do, which a whole bunch of smaller funds would never be able to do, because we just allocated 8% of our capital on a relative basis, but it was on an absolute basis a very large amount, and without that amount, you wouldn't have enough say on the board or in the company to be able to clean it up. So
is that the strategy, is to sort of be the good corporate governance, late stage sort of person? I mean, that's one way of adding value.
I'm saying that there is an advantage to a large fund which you wouldn't have otherwise at all. And I think if you look at the valuation at which we came into Uber, I don't think I can talk about specific numbers, but it was a significant discount to the last round they raised, number one. Number two, 2 months after we put in the money, you had smart investors. I know people don't think the Vision Fund is a very smart investor, but you had
which people,
like you on the stage. But there was extremely sophisticated investors who came in at a significant markup, and I think when you take the fund and the size and the scale of the fund, and you look at the number of investment professionals we have in our organization, we are basically, we've got so much intellectual capital within the organization about every sector, every geography. So when you take an example like NVIDIA, which, you know, most people, we were the largest shareholder of NVIDIA. We were able to track the company's earnings, I think better than anyone else could, because not only did we have a finger on the pulse on the hyperscalers, we had a finger on the pulse on all the potential disruptive companies like in the AI machine learning chip space. Again, most public market investors wouldn't even have access to that kind of information.
But NVIDIA was a public company when you invested.
Yeah, so. But I'm just giving you an example of what a large fund does. And then the third thing was, we owned this asset manager called Fortress, which was one of the first deals I did. We bought it on Valentine's Day in 2017. They had 20 million of Bitcoin on the balance sheet. That became worth 400 million by the summer. And when you buy something for 3 billion and you value 20 million at zero and it's worth 400 before we close the deal, we had to make a decision whether we should keep that or sell it. We did end up selling it, but it took 3-4 months to actually understand the entire cryptocurrency space. And literally in 3 months with 3 people, we looked at about over 150 ICOs. We had experts in the cryptocurrency space who helped us learn the space very quickly. And we were able to figure out that NVIDIA was not characterizing their cryptocurrency mining related chip sales appropriately, and they were lumping them together with gaming chip sales, which then helped us make a decision of being able to get out and make significant money for our LPs.
So that's an interesting sort of, let's talk about the exit potentials of companies at that scale. You know, when we have funds like ours, and I think, you know, you sell a company for $500 million, you can return half the fund or something like that, right? But at your scale, $500 million doesn't even, it shouldn't matter. You shouldn't even think about it.
Take Uber, for example, right? It's a pretty large stake.
Yeah.
We own 15% or so of the company. How many days do you think it'll take us to, how many days traded volume will that be?
I have no idea.
I'll give you a rough estimate. I'll be off by 10% probably. It'll be 4 days traded volume.
Yeah.
So, I mean, you know, on the other hand, we have a company called Gardent that we invested in 2 years ago. It just IPO'd. We own about 33% of the company. There, it's a different story because, first of all, it's a growth stage company, so it's growing aggressively. They didn't want to do a private round. They actually wanted to go public. They think there were merits to being a public company as opposed to staying private. And there, the company is still growing very aggressively. And I think the choice of staying private, taking large amounts of capital, or going public is really up to the founder and the management, right? Take companies like Spotify who had options of doing that, or take a Slack which is now thinking of going public without raising any new capital. It's relevant.
By the way, so there's an interesting point here, and I was going to ask you for this.
So I wanted to interject. So people question Softbank Vision for being too large, in the same way that people question whether blockchain is a fad. And my view of the world is, when some of the world's smartest people put their money, their energy into something like that, you can say, oh, they don't know what they're doing. Or you could question your own beliefs and say, actually, these people have historically been at the forefront, and am I in denial of the impact of technology and the opportunity related? So I view Softbank Vision as, when people tell me, oh, you know, technology, I don't know if I should allocate 5% or 10% of my portfolio, I'm like, open your eyes. It is coming for every segment of industry, and the reason why Softbank Vision exists is because they know that. So for me, this is the ultimate proof in the pudding that says, you know, this is a transformational force that's coming from every industry, regardless of what happens in the cycle. Cycles will go up, cycles will go down, and these guys will be buying up or investing in the foundational companies along the way.
Ibrahim, you should
you're not on his CI. I think he's on your payroll here, but
that's why I said allocate more capital.
Someone's paying someone here. The real question, really, and this is something which is important for early-stage investors, and it's a question of being able to, you know, have any say in the company's future when you have a massive private round after you versus a company going public where you have corporate governance, which creates for a level field for everyone. And that's my question to you, and actually to you as well, is, when you have a company and you're giving them advice as one of the shareholders of the early sort of, when you're the early guy, you probably have a better relationship with the founder unless something has happened on the way. It does happen. What advice would you what's better for, staying private with $1 billion on the cap table that has to be paid back before you see any money, or taking the company public? How do you think of that?
So my job in life is to fundamentally enable founders to make better decisions and run faster.
Sure.
It is not for me to control them, tell them what to do, etc. So I back the founders until I don't. In other words, I'm fully behind them to enable them to do their job. If on occasion we need a CEO change, which we try and avoid like the plague, then you can't support the founder anymore. And I would say in general, where I get uncomfortable is when the governance becomes overly skewed towards the growth investors. And I would say that some people are really quite smart about that, in terms of maintaining balance, because they know they don't have the ultimate truth. And some people can be overbearing. Now, when you have a case like Uber, you need to sort out the mess. And the mess was so entrenched that you sort of needed a big hammer, to kind of get it out of the way. But I think in general, we try and build governance very carefully to sort of try and avoid these situations. I like the long-term private approach, because actually for us, going public, like when we took Zoopla public, I mean, thank God we had belief in Zoopla, but we took Zoopla public for $1 billion. We ended up selling at an average price of $2.4 billion, partly because we couldn't sell. We're a fairly big shareholder, we had the restrictions, but in reality, it takes away our flexibility. So we're not in love with the public markets. We like efficient secondary markets in private, and we'll take half of the table at $1 billion, and kind of work our way up. The other reality is, the humble reality is, I try and add value in the first 100 days, 180 days. On occasion, I keep peace at the board, but the reality is, I will put the company on certain rails, and then my influence wanes. As much as we VCs like to think we're important,
the best founders
we're
are
not
the
that
ones
important, right?
that don't need you.
Yeah.
What do you think?
Well, I mean, we try to do fairly capital efficient investments, right? So to early stage investors, I think the worst word is dilution. That's the worst thing that happens to us. But certainly a lot of companies, because they're going after big markets, they wouldn't need capital. That's in some ways defensive. It's also strategic. Also allows them to grow. So what we do is, in those kind of deals where we know they may need to take on more capital, we would try to own as much as we can in a Series A. 20%, 25%, and expect dilution over the years. And then, it's important for us to maintain control a little bit in terms of our rights, so hopefully when they decide to do a large round, we can still maintain a 5 to 10% ownership, still a board seat, and having that influence. So we've done a deal with SoftBank, and they put $1 billion with one of our companies. And it's helped us grow. I mean, I think allows us to have more time. I think there was some liquidity from the previous investors, which is good, and some liquidity for others. But really gives these companies more options of when to exit, how to exit.
So secondary markets have become more efficient. I think that's one factor in the benefit of staying private, and I agree with you there. We had a conversation before we got up here on stage about global platforms versus specialized local teams doing stuff, and China being sort of graduating from having had the global platforms to being now, like yourselves, running your own fund. What's the pros and cons of that? And maybe Akshay, we'll have you talk about this sort of global thing that you guys are doing and how that works.
So year zero in China venture capital was essentially 2005, when a bunch of the top names in Silicon Valley, Sand Hill Road, came to China, Sequoia, KPCB. I joined Lightspeed in 2006 and started that practice. But we knew, my partners at Lightspeed knew that early stage is really a local business. So even from day one, we knew at some point we would do dedicated China funds. And it just a matter of evolution. I think if you look at China today, most of the top funds are localized, either spin out or definitely a local, maybe a global brand, but localized decision making in localized teams, because it's really about relationships, really about judgment. It's a very intimate type of close interaction with CEOs, and you can't fly in for that. But I think at a global scale, in terms of late stage, I mean, that's where everything's more fluid.
Was there any benefit that you gave up by not being part of the Lightspeed network?
It's certainly a firm like Lightspeed, other great firms in the Valley, they've been around for so many years, so much knowledge. So you do learn from that, and so we do try to continue to be engaged with Silicon Valley. We have people go there all the time to understand what's going on. I think that interaction is important. I see venture, I don't know Europe too well, but certainly in Asia, it's really Silicon Valley, Beijing, Shanghai. That triangle is very, I would say, very intimate in terms of cross-learning.
Has been for the last 10, 12 years, yeah.
At least last 10, yeah, for sure.
And Akshay, so you guys run a global team. How do you process things, and how do you define what resources goes where, et cetera?
I mean, look, we are excited about businesses that are late stage, number one, and number two, where their business models have been proven in a certain geography and we can take them global. I think our two largest LPs, are extremely committed to building their technology ecosystems in their respective countries. The government this is support from the highest levels. It's top down, and Ibrahim runs the tech hub over here and is responsible for setting up the tech hub. And you take a company like Oyo, for example. 3 years ago, it was a little startup started by a 22-year-old kid. And by the end of next year, it'll be the largest operator of hotel rooms in the world by the total number of rooms. And we've helped the founder. I mean, he was 22 when we gave him his first, we wrote the first check to him. We've helped him think through his whole business plan. We've helped him redefine the business in many ways, expand into different geographies. He's going to be managing a significant portion of the hotel rooms in Mecca and Medina. This will add efficiency to the entire system over there. It's also going to be good governance for the government itself. And I think this is what we bring. And I think the LPs who've invested in the Vision Fund also realize that the ecosystem we have between Sprint and Softbank Mobile in Japan, and Yahoo Japan, we bring something that's extremely unique, and that portfolio, that ecosystem continues to grow because of the large stakes that we have in these companies. We can never force a founder to do something, and even these companies where we control them, like Sprint and Softbank Mobile, we can't force the management of those companies to take irrational decisions. But as long as it makes business sense, our ecosystem is here to turbocharge growth of businesses that have proven themselves out in certain geographies. And I don't think there is a match to that scale and ecosystem. And I think Ibrahim can talk more about what they're doing at the tech hub over here.
So one, that, and second, as you think about funds and investing in funds, would be really interesting to hear your point of view on size and how that defines your decision making to partner with people.
So our smallest size for a fund investment is $1 million. Our largest fund commitment is $15 billion. We don't follow the same process for the two investments.
I would hope not.
What's that?
I would hope not.
Yes. But I had to personally recommend these two investments of these different sizes. And again, I agree with what Ron said. early stage venture is a very local business. It doesn't scale. So we need the $1 million commitments to work with these fund managers that are very, very intimate and active and supportive of the early stage funds, of the early stage founders, and working with them through those. The decisions that have to be made in the first 12 to 18 months of a business journey, which ultimately could potentially shape the future of that company. We can't do that, they can. The $15 billion commitment to the Softbank Vision Fund, and which is Masa's vision, is not technology on its own, but how is technology now changing transportation and healthcare and food and logistics and space, all of it. And if Masa and the Vision Fund team could either through one investment or multiple investments create a $500 billion company or a $300 billion company, and the top 5 most valuable companies in the world today are all tech companies, then that's a success for us. Last but not least, is the comment around, is the point, I think Fred made it, or actually is around talent. Mubadala over the next 5 years, will become one of the largest and most significant technology investors in the world. That is a clear mandate from our leadership. Why? Because the exceptional talent, Fred, you talked about that, the exceptional talent today that's graduating from some of the best schools around the world, they don't graduate and say, I want to go work for GE or Walmart or Dow Chemicals. They say, I want to go work for a technology company or a technology startup or a technology leader that's shaping the world. And we as a global investor have to remain focused on where this exceptional talent is going, because that's ultimately how we'll create financial value for our shareholder.
It makes sense. And for you, Fred, project out 10 years from now. What does your firm look like?
Yeah, so like I said, we are artisans, and we make things with our hands, you know, like our friends at Beko in Dubai. You know, we are in team alchemy, we are in talent matching, we are in strategy definition, and it's very hard to scale that up without starting to have some dysfunction in your decision making or your team. So for me, SWAT units of 4 or 5 people that move extremely fast and make decisions in a very transparent way is actually the core of our business. And then we have to get the entrepreneurs to choose us, because increasingly the best entrepreneurs can choose their capital. So I'm small by design, and I will stay small by design, and my job effectively is to build a platform where the next generation of talent come and expresses itself.
But your job also is to make sure your investors get the best return by giving them
Which
money.
is why we're small, because we don't want to dollar average our way up into 3x returns. We'd like to do 5, 6, 7x returns. And you know, it is a fact of life that is, especially now that we can metricize everything and now that we can scale these companies fast, and it's exactly what Ron's saying, if you don't capture value on the first check, you're not going to catch it later. Because, you know, by the time a company is scaling, I'm going to have DST or Founders Fund or Sequoia or Green Oaks or Vision, you know, just like swarming that company. So I do what's hard, which is what I consider hard. It's funny, by the way, if you're early stage, everybody thinks you're a gambler. If you're later stage, everybody thinks you're a banker, right? And whatever stage you're at, people look at each other that way.
Both are really interesting professions.
Right? So the reality is we have a method, but the difficulty and the beauty of our job is to deal with ambiguity of information and imperfect data, right? And that's our informational edge. His informational edge is to have a global view on everything that's happening in public and private, and to derive, you know, insights from that. So if I don't have insights, I don't move into that space, because otherwise I'm not creating value. So for me, it's almost that simple. It's sort of, you need a kind of unique edge. And let me tell you, we are going to see some disruption. So I'll give you a quick example. Ryan Kalbeck out of the US is building a programmatic fund to invest in direct-to-consumer and retail companies. Why? Because it is possible to almost perfectly model every direct-to-consumer brand, because their metrics look exactly the same. So he's saying, I will analyze 10,000, I can give you an investment decision programmatically, literally within hours, and then I will leverage my network to make sure you derive value. Now, these models are fairly disruptive, and they're coming. I can't imagine the hedge funds are going to stay out of privates for much longer.
Like any other industry, venture capital or technology investing is becoming more mature. Not quite mature yet, but let's say it's in its teenage years, and will be very different 10 years from now. So for Akshay, Vision Fund 2, is that sort of 200 billion?
We're still...
Should we ask Ibrahim what his commitment is?
We still have more capital than the largest technology private equity fund in the space to invest. And I think hopefully when we finish that, if we are doing well, I'm sure Ibrahim will write us an even bigger check.
Absolutely. Absolutely.
But fund size creep is pretty well proven. I mean, you have to look at what Sequoia has done and what Lightspeed has done. And how do you think of sizing and changing and strategy, and where's your head at right now?
We won't do anything remotely close to the Vision Fund.
Of course, yeah.
We will not. And if SoftBank continues to deliver returns, we will support SoftBank moving forward. It's interesting. We had this discussion with, when we met Sequoia over a couple of years, they said, well, we like to keep our fund size X because returns are driven by...
That's traditional wisdom, yes.
Correct.
Yeah.
And then one day Sequoia shows up and says, well, we're raising a $10 billion growth fund. Okay, why? Well, because all the micro VC funds or the seed funds are taking all the great founders at the early stage from them, and all the big funds are taking the great companies at the later stage. So Sequoia, this is Sequoia, by the way. Sequoia is, I mean, I think we can confidently say Sequoia is the #1, okay, maybe #2, depends on venture capital
who you ask.
firm in the world. Said, and this is Doug Leone, who is, the managing director. We could be out of business. We could be out of business unless we change and evolve. And our view there, and we engaged with them, and our view there was, fund sizes could get small again, or fund sizes could grow large. I think just like technology, we have to be flexible with capital markets, with changing technology dynamics, with founders and industries, and remain flexible. What's important is continuing to find and invest in the great managers, because I think the really great founders will only take money from the great managers that believe. By the way, this is one of the most, for those who have not spent, I have been very fortunate to spend time with Masayoshi Son. I find it to be one of my luckiest things to do in this business. He believes deeply, deeply in the founders that he invests in. And that's what gets these founders excited about the investors.
Okay, we have a few minutes left, a couple of minutes. If there's any questions from the audience, please direct them to the panel, any one of the panelists, or generally, and I'll direct it. Yes, over
there. Dave McClure, you guys are deploying more and more capital in different stages of the market, and there's certainly growth in the micro VC side of the market, but continuing challenge in venture is the illiquidity of the asset class and lengthening sort of period of the asset class from an LP perspective. Have you guys looked at doing more in the secondary side of the market? I know SoftBank is basically already sort of acquiring some of their position through secondary purchases, but structuring more secondary trading in fund interests as well as companies.
Yes.
I can take it. Hey, Dave. Good to have you back.
We're giving you liquidity. He said that. He acknowledged that.
He knows the answer. By the way.
So I think actually there's two competing trends here. And just to be a little bit contrarian, because we metricize everything precisely, because we have platforms and analytics, etc., we are actually able to scale companies faster than I've ever experienced. And before people said, oh, you're building on the cloud. But now we're not just building on the cloud. We're measuring week by week. Like when we launched Deliveroo internationally, we could check every city against the speed of progress we had in Paris. And, we got a problem in Singapore. Is it due to supply? Is it due to management? And so we measure stuff so precisely that we're able to titrate capital fairly accurately and then scale them fast. PillPack was 5 years from 0 to $1 billion. You know, Deliveroo was 4 years from 0 to $2.5 billion. That's pretty quick. And so in a way, the value creation is accelerated when you hit the right model. And then on the other side, you have a liquidity problem. Now, the only real solution against a liquidity problem is to build strategic assets that somebody needs to buy, right? Which is something I kind of obsess about. And to answer your question, we are absolutely looking at more secondary, and it's become sort of a fact of life. There is way more pools of capital that are looking. There is intermediaries that specialize in that. And so I think it's becoming a factor. A lot of private investors don't get access early enough, and so they come in hard. So for us, actually, I think in a way we have more options. And I'm fairly confident we're going to solve the duration issue personally, you know, instead of having to wait 12 years. I mean, I see reduced cycle to value creation that I think are great for funds like us, because of course, you know, duration is a killer for seed funds. Right?
Or the fund structures themselves will evolve, where you have evergreen pools of capital and liquidity is less of a concern, which is, by the way, where most of the, I would say, large pools of capital in the world are moving. Now, our time is up. Thank you so much to the panel. I'm sure 10 years from now, we'll be talking about different things, maybe $1 trillion fund or something like that. But please join me in thanking the panelists, and thank you for coming.